So I think a good place to start would be just for a very brief intro from you guys. So Keith, maybe do you want to kick off with your fund strategy, portfolio structure, turnover, etc.?
Sure. So my name's Keith Smith. The fund that I run is called the Bonhoeffer Fund. Our strategy it started out as a deep value fund, and over time we've looked at the strategies developed into more of trying to find sort of sustainable growth companies selling at low multiples because the market misperceives these businesses changing over time. And so a lot of this has to do with companies associated in distribution and basically distribution type businesses that are sort of transforming and basically taking advantage of the arbitrage that can happen where the market's valuing, let's say, a business the way it was 10 years ago. You can get some decent growth, and the multiple that's being applied today is what it was in the past. And so you really get this multiplication effect where the multiples could go up and the earnings could go up at the same time, so creating sort of a nice sort of Davis double perspective for that. So that's primarily where we've evolved, where I and the fund have evolved to at this point.
Great. My name is Stephen Kiel. I run two funds. The main fund is a fund called Arquitos Capital, primarily a special situations fund, but we're also a major shareholder in IndyCorp, which is the parent company of Willow Oak Asset Management here. So we started together Willow Oak a number of years ago in order to provide these outsourced operations in this way. And then last year I started a niche fund as well called Arquitos Capital, or Arquitos Epicus, sorry, along with my friend Thomas Brazil. And for that fund, we're basically taking the best ideas from my main fund and some of his best ideas, most asymmetric ideas, and we're owning 4 or 5 stocks, call options, warrants, really kind of all or nothing. So that part of it's been a lot of fun. But the main fund is really the primary focus day to day.
So the idea of this session is to provide a broad outline of your research process, potential biases we all are under in that process, and just explore that a bit further. So I think a good place to start would be a kind of fluffy topic, but I think sourcing ideas. So Keith, how do you come across new ideas? How do you know when you've found something you want to dive deeper on? How do you approach that?
It's actually changed over time. I mean, I started out as sort of a deep value investor. My background is doing business appraisals, so basically valuing private businesses. And when I started the fund, our approach was primarily to try and find companies that we thought were underpriced in the market given sort of the industry and countries they were operating in. But what's happened over time is I sort of dove more into, thinking about what are the values of growth for businesses. And if you can identify what those values of those levers or particular the KPIs of growth of those businesses, what's caused by them, and looking at the changing growth over time, then you can, I think, get some real interesting, because I think in terms of my sourcing process at this point, it's looking at businesses that have that kind of model and what other, it's primarily starting in the United States, since I'm familiar with the United States, but then finding that kind of model in another country or maybe another sector. I'll give you an example. It's probably easier to explain it this way. So if you look at like automobile dealers, they're basically in two businesses. They're buying and selling cars, and they're in a service business. And so over time, what's happened as these companies have sort of consolidated and gotten bigger, services have become a larger and larger portion of their revenue, and so that's almost like recurring revenue business. And so I've looked at that and said, okay, there's some other things going on in the business where that sort of happens over time. And so then applying that, saying, okay, this happens in car dealers. Well, let's look at like truck dealers. Let's look at like RV dealers. Let's look at, boat dealers, and sort of see what characteristics are associated with those. And then also some of the drivers of growth. One of the key things in automobile dealers in terms of driving going forward is M&A. And M&A can only happen in countries, where you've got willing buyers. So where you're going to find some really interesting, I think, auto M&A stuff is going to be in the United States. You're not going to find it in Germany, because in Germany there's not many willing sellers, In the United States, you'll find a number of willing sellers. So it really varies, but I think my process has really gone more to look at what are the underlying causes of growth and then sort of saying, okay, let me try and find some change in that growth metric over time, and then sort of, basically buy it where I think it's a really decent price and the market isn't necessarily incorporating that growth aspect of the business or industry over time. So I think that's sort of an example of an evolution of the process, how it's evolved over time. So.
Yeah, sure. And I think for me, there's really two different approaches. There's the discovery of new ideas and then the maintenance of existing ideas. Because I'm a little bit more special situation oriented, I'm always looking for new opportunities and catalysts or something that might have occurred that might be of interest or might be misunderstood. So my process is every morning I have an RSS feed. I have different keywords to that. I have different SEC filings. And the first, say, hour or two of the day, I'll just kind of scroll through. I, subscribe to a bunch of blogs and research services and things like that as well. And, I'll just kind of scroll through there, have a cup of coffee, see if anything catches my eye to look at later. And I think that's pretty good for new ideas, combined with kind of a network, effect. I've had the fund for 10 years now. We've met a lot of great people, a lot of you in this room. So a lot of sharing ideas. If we find something interesting, we definitely utilize that resource. We can talk about maintenance ideas later. I think that might be something to bring up later. But I think the RSS feed and just quickly going through a lot of ideas and seeing just what catches your eyes from pattern recognition in the past.
Well, one interesting question I've always thought about is balancing maintenance versus new ideas. How do you think about, and it's not a perfect answer, but how do you think about how much time you spend dealing with your current book versus new ideas?
Yeah, I mean, it's a good question, and I think it does depend on your strategy. So for me, it's like if a catalyst has occurred or if it's been delayed or something has changed, then sometimes you do want to totally reevaluate the position. But if it's just in the process of occurring, then you put a news alert up on it. You're kind of keeping an eye on its different regulatory filings and things like that, and just let it play out. It's important to have patience for some of these things. And I should have mentioned, a resource that it seems, I think 5-6 years ago you would have thought was crazy, but even just using Twitter. Sometimes you even put up a question on Twitter. Hey, what is your your best asymmetric idea out there, and you'll get a ton of responses, and it's a good way to get some idea generation.
Do you trust that, though?
No, it's an idea generation. Idea generation.
How do you think about, because Twitter is obviously, I guess most people are on Twitter, either publicly or privately. How do you think about the risks of groupthink and, all the biases that you get when you start talking about a stock on...
Well, I think you don't want to outsource your research, but if somebody points something out, hey, this catalyst is about to happen, or this, for me, maybe this litigation thing has occurred, it's like, oh, I didn't know that. Right. And most often, there's companies you might have followed for a long time, you just don't know you didn't follow it close enough to know the current details. So it's more of like a news flow to focus your attention.
So I found, I don't know who else is on Twitter, but early FinTwit was actually quite nice, where people could discuss companies and not feel like they have the answers all the time. And now it seems like it's who's got the answers to everything. and who's got the best idea.
Well, I think part of it's curation, right? You can sort of say, okay, these are the people I trust. Maybe here's a new guy with a new idea, but I think what I've done is just try to curate the people you can trust, at least initially. And then, but if you're casting a broader net, like Steve was talking about, is basically you can then go through and analyze the specific businesses.
I hope I'm on your feed.
What's that?
I hope I'm on your feed, Keith.
Okay, you are.
Well, I think for me, I don't trust anyone, so it's my own.
That's the other way to do it.
My own personal issue, so I'm really just looking at it for to kind of direct the attention and stuff like that. I think some people, especially now, to your point. Back in the day, when it first started, I think it was much more of kind of a community, and now it's people are selling things on it. People are trying to pump their stocks up, and this isn't just kind of the meme crowd. These are actually kind of traditional value investors that are doing that. I think it's all like
moved to DMs, maybe.
Yeah, so you have to be a little careful.
But let's talk about a couple of actual real world examples. And so, Keith, maybe run through an example of a company you've looked at. You've found something interesting. How did you approach the research process?
Well, I'll give an example of a company I think it's really interesting. It's a company called Ashtead. They're an equipment rental company. They're headquartered in the UK. Their business is primarily Sunbelt rentals in the US. The idea just came from me just thinking about, okay, what really drives the business model? A simple way to think about Ashtead is they have something in the business called dollar utilization, which basically represents saying, okay, if you buy a dollar's worth of equipment, how much revenue does the company generate over the period of time at which the equipment will be rented, plus the salvage value divided by the original equipment price. So if you look at Ashtead's numbers, their dollar utilization is about 57 cents for every dollar they invest in equipment. So what they'll do is they'll invest in equipment a dollar first year, they'll get 5 years of 57 cents, in other words, then they'll get a salvage value of roughly 75 or 80%. What they do with their equipment is they buy new equipment and sell it when the need sort of goes down. So if you do that, you're getting about a 3 times return over 5 years. And if they can repeat that process, you can get a very favorable return on that business. So it should be able to, you add G&A on top, but it should be able to grow at at least 15 to 20% per year. And the business sells at roughly around 15 times. But how my process, I think, has changed a little bit from historically is before I was looking at primarily, okay, interesting businesses and multiples. Now I'm trying to dig into what's the drivers of growth, and are those drivers of growth sustainable? For example, the reason Ashtead, I think, is an interesting business, you just see the economics there, but they have a very long runway. So part of what they do is they cluster their groups. Only about 50% of their groups are clustered, and the market share they have in the United States is probably like 12%. So there's still a very long runway. And so I think probably for the next at least 5 to 10 years, you continue to get these kinds of returns. And what's interesting also is you can see the returns are getting better over time. So one thing you can take a look at is say, okay, what was this business making 10 years ago versus now? And you get a little of the momentum and understanding what's really driving that is their basically ability to do this, what's called specialty leasing versus core leasing. So in essence, there's my process has changed to sort of digging into what are the drivers and coming up with KPIs and sort of tracking those over time. So I think that's, in general, sort of an example.
But you're only looking at public filings, or you're speaking to management, former execs? Like, what's the...
It's a combination. A lot of it is you're trying to understand the business model. And there's a lot of different sources where you can get that from. Initially, you can get it from the filings, but the management companies, I think the companies that are the best, really understand their model and can communicate it very clearly. That's a huge, I think, underappreciated aspect of some businesses. If you look at some companies in some industries, management will talk about things that aren't important in their management presentations, or they'll be really wandering. The guys that really understand the key KPIs, you should be able to look at it and they're really good communicators. And when you think about the way they're running their business, if they can't communicate what's the good aspects of the business, how are they really running their business, right? I mean, if these guys have a very focused thing, another example of a company like that is called Asbury Automotive. They have a very focused vision. They lay everything out, and you can by just looking at their presentation, you understand what their model is. You look at some of the other competitors, and they don't talk about those types of things. That's an interesting test, I think. But then it does include talking with people, actually talking with management, talking with other people. And I guess most of the management stuff interactions I've had is I sort of develop a model and then ask them specific questions as opposed to, doing more of a broad-based interview. And a lot of it probably depends upon the size of the business and sort of the business model that's there.
Yeah, and I think to the flip side of that kind of management interaction is if they are too slick. If their presentation is too well put together, and look, you're gonna to become a CEO of a decent sized company, you have to be a pretty good salesperson, right? And so when we come in not knowing kind of the inside information of the company, we're doing the best we can. We're trying to pick up different clues along the way, and you have to be very skeptical when you're sitting down and talking to them and trusting kind of the information they're putting out in a public way. Because
what do you look? What are the red flags you look for?
Well, that's slickness for the
exactly.
first.
What do you
for
mean
the first
slick
thing.
though? Like a
when,
a slick suit, or slick back hair? What
yeah, I mean,
for?
the investor presentations and things like that. I mean, I typically don't meet with management. I might talk. If I do, I would really want to talk more about competitors than themselves. But when I used to meet with management, especially the smaller companies, you'd go in and see what their office was like. You'd just kind of see what kind of car they drove and things like that. I think Buffett and Munger had an anecdote today, right, about that bank that they brought in the CEO of the bank and he wanted to buy a new building immediately so he could have a little bit more prestige. So these are little clues. Nobody's going to come right out and tell you.
Right. But they never met management really, Buffett, and in the early days, I don't think they met many.
Right. So, but I think the thing is, you have to figure out the clues to that attitude and that personality type of who's in charge, and especially at the leadership level. That's going to trickle down to the entire company. Are they a bureaucratic type of person? Especially smaller companies, you just can't have that bureaucracy. And so I think those are the things you're trying to get out of different interactions or meetings or even talking to competitors.
Yeah, I mean, part of what you're trying to do is build like a story or narrative, and you basically are trying to get either confirming or non-confirming information, because all your valuations and all that kind of stuff is all based upon narrative. And so from my perspective, what you're trying to do is trying to find confirming and disconfirming information in the narrative, but you're starting out with, like, let's say a bigger concept and seeing whether the specific growth can happen over a period of time. So yeah, I mean that's
But I mean, let's just dig it a bit deeper then, because we think about this a lot in our business, and how to spot bullshit effectively, right? From current management, but also former executives. And so, how do you, when you're receiving information from current management or former, how do you handicap that information?
What's available today is there's a lot of KPIs out there where you can test some of the facts that they're actually giving you. And if you understand the industry enough, you can see what they're doing. Another thing that's really more of a bugaboo me than anything else is that, so if you take a look at, let's just take an industry like BDCs. BDCs, probably the most important metric of BDCs is return on equity, or how much return are you going to get for these equities. You look at every management presentation except for one, they don't even talk about it. But the one guy that talks about it goes through and deconstructs it, and so you can understand what the business is. Those are the types of examples, I think, where you've got a bunch of people that, like you're saying, how much is the I'm sure the management knows what they're doing. It's just that they haven't spent enough time to communicate what's important and how to do it. And I think if you look at some industries, that's a very important thing to really sort of, surprisingly enough, it's a very rare skill in terms of some of these businesses.
Do you subscribe to In Practice or Tegas or any of the other services?
It's a good question.
And how do you utilize them?
No. In Practice, I do subscribe to a number of the resources, and I think they're very good for you to get up to speed on an industry. They provide almost another level of what, you can read the filings, you can try to understand the business, but it's actually providing insight into how businesses are run. And it's a totally different, as an outsider, there's a lot of stuff you don't see that happens on the inside of the business. And it's provided, what these third-party services do is they provide those specific insights. Now, the thing that I really appreciate about In Practice is they focus on certain types of business models. You can do different things. You can do more of a general focus, which is more of like what I think a lot of the other larger providers do. But what I appreciate about In Practice is they focus on a specific business model. And so I think there's different groups that do that. But for me, it really provides some additional insights into what's really going on in the business beyond what you can find in the public filings and all those types of things.
But wait, I have a better question. Yep. What do you think are the disadvantages of using primary research providers or speaking to executives? Steve,
yeah, one thing that comes to mind for me on that point is how do you build the commitment as a portfolio manager for the position? Because your analysis might be spot on, the research that can be provided to you might be great, but if you're not able to, over time, build the necessary commitment to continue to hold a stock when it might go down 50% because of something, some sort of misunderstanding, right? So when do you kind of question or re-question your thesis? And I think it's kind of like a subconscious thing. And I think the more work you put in yourself, some element of putting in the work is actually just to also create that commitment in order to buy and hold.
Well, and I think part of the thing, too, is what I've typically done is try to devise KPIs, very specific quantitative things I can see, and to show me whether the business is getting better or worse. And if you can look at those quantitative KPIs and just sort of say, okay, this business is moving in the right direction or not. Examples of that could be like, okay, if you're in a consolidating business and the margins aren't going up and the turns aren't going up, there's something wrong there. That's the way the business model works. And if there's something wrong, then you need to understand it. But I think for me, specifically looking at KPIs helps out a lot in trying to develop those. And what the KPIs are basically the key management metrics that the whole team is working towards to make the business better.
What I'm hearing is there's no disadvantages.
What's that?
What are the disadvantages?
Of using. Well, I mean, I guess the disadvantage could be is if you just use them in isolation to buy and sell stocks and not try to get other confirming and disconfirming information and drive it from that perspective. You need to really do, as Steve had said, you need to do your own research and bring it, what you're going to bring to the table or other models, maybe contrary opinions. Because I've seen in different, when you look at some of this research, a lot of times you'll get interviews from competitors, and they'll have different views on things, and you need to really understand. Okay, well, this is this views, but I think what I try to tie a lot of stuff back to are quantitative KPIs, which at least to me is providing giving me the feedback that the business is moving in the right direction, not the wrong one.
Yeah, and I think the ownership of that position is an important concept because a number of years ago when Manish Pabrai talked about the cloning concept, people, I think, wrongly assumed it's, oh, hey, Buffett owns this stock, so then it's a safe stock to own, or Manish owns it, or someone else does, a famous investor. And I think there'd be a lot of kind of lemmings following along just with that. And then, if it didn't work out, now it's not your fault because, it was someone else's, Manish owned it. And so I just, outsourced my research to him basically. And I think you have to be really careful about that because the concept of cloning should be an idea generation concept. And yeah, obviously you have some trust, in some investors that you respect. And you can defer a little bit to some of their judgment on it, but just a little bit. Because ultimately you have to do enough research and you have to get comfortable enough with the position to make sure that it, in some ways make sure it's your idea. Like I've had positions through the years where I actually don't remember exactly where I discovered them, and then later on found out, I had a friend say, oh, remember that, when we talked about that company, and, I thought I found it because through the research process, I convinced myself I found it, which gave me the commitment level to hold it, for a long duration. I think that concept is very important.
Yeah. No.
Well, going back to the risks of research, and I think one of the big things that we've found in primary research, which is interviewing typically former executives of either a target company or customers, competitor suppliers, one of the biggest risks is pretty much just jumping straight to doing the primary research without actually doing your own research independently. I think one thing we've found with partly maybe our problem is that where these services are now so much available, where people find it easy to just jump on a call with an executive straight away without doing their own research and can kind of be subject to
now they're telling
bias.
you the story before you know the numbers behind the story.
Yeah.
And so it's, that can be dangerous.
You can't handicap that bias because they have their own biases, they've left the company or X, Y, Z. So, how do you go about making sure that you have your own independent view on an industry or a company before doing more research?
I think part of it is, for me, is just like, for example, in this automotive dealer sort of space, clearly the market doesn't believe the numbers are sustainable just from the valuation. But when you look at the underlying research and the underlying sort of assumptions that go behind to get you to that place, that's part of, I think, what you need to take a look at too is, okay, if this company is going to double earnings in the next 5 years, what assumptions do I need to make to get there? and then are those inputs to those assumptions achievable? Have they been achievable in the past? And looking at those types of things and then tracking those going forward, I think is important.
Yeah, and I think for me, the foundation of my research is always the regulatory filings, and making sure you understand and have read the last couple 10Ks. You're following along in the queues. I think the proxy is really important to look at. There's times where there's some hidden information in there that has to do with incentives, related to senior management. So I think that's really the foundation first. And once you are very well versed in that, then you can go on to a different type.
What's an idea, Steve? You've been
So I won't disclose the name, but there's an idea recently that came across through a regulatory filing through like the RSS feed. That basically it's a kind of a smallish company, but it talked about putting itself up for sale. And after I read through that filing, it's like, there's something about that company that sounds familiar. So I set it aside for later. And then once I kind of went through the filings and then looked at some other research, it turns out I had a few other colleagues, a few other smaller fund managers had actually written it up in their letter. So I read a lot of like other investors' letters, and I don't specifically remember a lot. I mean, I'm kind of going through them just to put the stuff in the back of my head, because then 3 months later I come across this 8K that said, I think I know that name. There's something about that name. And it was because I read it, 3 months earlier in someone's letter, and it seemed interesting, but not interesting enough to dig into at the time. And so, I think there's something called a brain worm. You have to be very careful about the information that kind of worms itself into your brain. So you have to curate your information sources, and don't get distracted by kind of junk information. And I think that's kind of part of it. And in this specific case, it led to an investment in this company that I think ultimately, I'm still building the position and it's still working its way out, but I think ultimately it could be sold for 2 or 3 times of what it's currently trading at.
How much do you spend time reading letters, other investors' letters?
I'll read through most. I'll probably read 100 letters every quarter or so. I just kind of scroll through them. We're not reading it like every. You're just kind of scrolling through, and a lot of these people, you've become friends through the years. If there's something that catches your eye, you can give them a ring and stuff like that. So I think in that way, it's more of an idea generation and kind of curiosity thing, and also I think it is valuable for kind of that brainworm idea to kind of keep yourself occupied with people that you think are interesting and that you respect their opinion.
I mean, something I found helpful too is I've got one particular manager that we bounce our ideas off each other. That's very important to have someone and you're asking them to be the devil's advocate, because all of us have biases, and someone who's not you probably knows where your weaknesses are, and they can point them out. And it's also, I think, important to get together or talk with groups of investors that have intelligently analyzed and reviewed companies. So if you can get like a group of 3 or 4 investors that may take a look at, I know, just give an example of what one of the in-practice interview you guys did, which was great. There was a Carvana bull, a CarMax bull, and I was sort of like the traditional automotive bull. And you get some really interesting insights from that, because you see what the pluses and minuses of each of the models are. And I think from my perspective, that without that conversation, I wouldn't have been able to see that. I think that's that's part of the process is coming up with an ideas and just bouncing it off other people to see, okay, what's the positives and negatives, and try to seek out people that disagree with you and sort of see what their arguments are, and do they make sense, and is there data to support one point versus another?
How's that Carvana bull doing?
I don't know. But yeah, no, that's I think just the overall part of the process is basically trying to get confirming and disconfirming information, because over time theses are going to change, and intervening events may change your position or the way you look at companies over time. And so that's one way I think to fight bias, is basically try to go out and seek disconfirming sort of information, because we all have these models in our head of saying, okay, this is the greatest investments in sliced bread, right? But you're just like, okay, find someone who doesn't think that, and sort of think through their arguments, and then say, okay, what makes sense from that perspective?
Yeah, and that's where you really have to be careful about some of these like kind of hedge fund hotel stocks. And it's really better to utilize your network to to do that, to provide disconfirming information, not confirming. I agree.
Yeah.
So, I mean, let's take you have a company you're interested in. You go and meet the management. What are you looking for specifically to tell whether you can actually trust these people?
Well, I mean, for me, part of it's track record. So there's a small company I'm looking at now, small Canadian company. You look at their track record; they're doing great. The one thing they're following an M&A strategy. And my concern was, okay, these guys are doing stuff in these little niches. What happens when the niche runs out and you can't do M&A anymore? Because a lot of the high returns on capital were basically predicated upon making good acquisitions. And when I talk with management, the thing they said is, okay, the way we look at this is not in these specific niches, but we look at more broadly in terms of any kind of, let's say, they were focused like on, heating storage tanks and tanks that go on the back of trucks that are basically, for transporting natural gas and liquids. And he said the way we think about this is we think about it as really any metal bending industry. And so from that perspective, I think it really provided I think what I'm trying to find when I talk with management is I've got a model in my head. I know what I would really like and trying to get very specific information from that, because I think you can tell a lot from a company's track record, at least initially, of what's going on and sort of what's their reputation over time in terms of the way they look at stuff. So,
is there? I mean, if you look back in the last 5 years, is there anything in your research process that has changed, or any mistakes you made in the past that which caused you to change your process?
Yeah, I think for me, probably about 10 years ago or so, I used to get involved with a lot of companies with net operating loss carryforwards. And that was good for a little while, for a few years, and then it kind of got overdone, and companies would basically take over, activist investors would take over these companies with tax assets, and then they would acquire another company, lever it up sometimes, which kind of defeated the purpose because then you wouldn't have taxable income. But anyway, that was kind of the end of that trade. But I think the idea behind that trade is something that permeates. What type of tax arbitrage, for example, as a special situation investor? And then things changed, for example, during once the corporate tax rate changed and went down and things like that. There was a position, I want to say it was like 6-7 years ago, it was the REIT conversion for Iron Mountain, where it was it was held up for a while with the IRS because it was the first kind of non-real estate attempt to create a REIT. And it was held up for a year, but there was a number of arbitrage opportunities along the way with that, with a special dividend and a mispricing, and there were some options mispricings and things like that. And so I think that all goes to, for me, that tax arbitrage idea. That's the foundational idea, but over time, depending on the circumstances, you literally could take different sides of the same, situation, so to speak.
I mean, I think for me, the biggest thing that's how my thought process has matured over time is thinking of businesses in themes or narratives, because that's the way most people think, that's the way most people work. I naturally have an engineering kind of, engineering math kind of a background, and that almost goes to the opposite of narrative, but narrative is how the world works, inspires people, does all that kind of stuff. So for me, it's just sort of incorporating that and thinking about themes and how what companies would basically be able to take advantage of those themes over time. Like a recent example is, okay, well, interest rates have gone up. Well, what does that do to the cash flows of businesses? In most businesses, it shifts tons of cash flow from the equity to the debt. So, okay, that's going to have a huge effect on the valuation of debt versus equity. Debt was basically yielding zero now. Now you can get tons of debt. So what are some ways that you can look at? Examples could be like banks or BDCs, where all of a sudden now you can get like yields, probably going in yields of maybe mid-teens numbers. If you get mid-teens on first lien secured debt, you're just like, okay, the hurdle for any equity to get above that is increased quite a bit.
I mean, is there anything that you've changed in terms of what you read, or there's so much information everywhere now. There's we're producing the interviews, but Tegas is giving you as much information as you want. How are you curating your information flow to...
Yeah, and I mean, again, that's an important piece of it, and it's very easy to get distracted, speaking of Twitter and other things like that. But, you really have to use these resources for what they are and really be disciplined and create good boundaries for yourself. Yeah, for me, I don't watch the news anymore, basically. I just think it's designed for entertainment, and I don't think it's helpful. I think a lot of the political discourse is harmful for your intellectual honesty that you want to cultivate as an investor. So I just try not to. I used to be when I was in college and right after college I moved to Washington, D.C. I went to law school there. I worked on Capitol Hill for a number of years, for 6 years before I was an attorney. And I was really very heavily involved in that. And I'm to the point now where I think it's very harmful to be exposed to as an investor. And so I try to avoid that completely. And any important news that comes about, I'll be made aware of it in some way. So, I'll still read the journal every day. But back in the day, I used to read, 3-4 newspapers a day, and now I don't think that's useful.
Well, Steve, so just on and I'm going to open the floor up for questions in a second, but given you have special sits mainly, how do you think about conviction in special sits, in what you do? And I mean, if you've got an example, I know we spoke about Burford earlier, a very specific case. Yeah,
because it's not a commitment in the company itself or in the management. That's where I think our approaches are a little bit different. It's conviction in the actual idea of whatever is occurring. So we talked about Burford before, kind of coming up on stage here, and this is a litigation finance company that recently won a big award. But it's still probably significantly mispriced from here, but there is some time period where they may or may not be able to collect from the government of Argentina. So, for something like that, it's like, okay, do you trust, do I need to trust, for example, the business strategy? Well, maybe, maybe not. In this case, no, because the reason I'm in it is because of that, the award, and when they can get it, what they might negotiate, et cetera, et cetera. So there is some trust in management you need there, but what you really need to trust, and I kind of got in after the award was filed, but if you got in before, you have to trust your legal judgment, you have to trust kind of some of the information there and the timing. So it's much more kind of situational based. And, some of the things I'll get involved in might be divestitures or spin-off or some sort of activist investor that gets involved with the company where you're really, trusting something different than the company itself. And I think a lot of that comes from pattern recognition. And you're definitely going to make mistakes like you will in anything else. So you have to size it appropriately. But for the company that just filed the 8-K, for example, that said it was going to put itself up for sale. A lot of companies might say that, or they're going through that sale process. It doesn't happen, but there's some specific things involved in that reminded me of previous.
Do you speak to management in that case, though, or is that mainly your own judgment?
No, I don't think that's going to be useful in that case. But some of the things that made it interesting and some pattern recognition from previous instances was, they had a business that had a few different lines of businesses. They weren't necessarily related. They sold off one business. They were winding down a second business, and then the third business was where the value is, right? So now they're putting that up for sale, which is ultimately the entire company. And that's a much different situation than a company that just says, hey, look, we're having some financial difficulties or something like that, and we're running a sales process.
All right, great, thanks. Sliding over here.